everyone. I hope you're having a good day. This lecture today is over valuation, and specifically we're going to value a firm and then value a stock using the free cash flows to the firm model. What I'm going to put out online for you are the overhead slides that go along with this, so you can take notes as you listen to this if you'd like, and also a set of spreadsheets that I'll be working on throughout the lecture. Ultimately, what you'll do with these notes and with those spreadsheets is you're going to have an assignment that I'll put out online either tonight or tomorrow for you to finish over the next week or so. So what we're talking about today is the free cash flow model and using that to determine the value of a firm. It's also referred to as the corporate valuation model. And in this model, we're going to first divide up assets based on whether they're operating assets or non-operating assets. And just as a review, operating assets are assets used in the day-to-day operations of the firm. These are assets that need to grow with sales. For example, inventories, if we increase the amount of sales that we have or revenues for a year, we expect inventories to increase to reflect that. We expect accounts receivables to increase to reflect that. We expect net fixed assets if we're reinvesting in the firm and growing the physical size of the firm in order to be able to achieve the amount of sales that we want. We expect those to increase as well. So those are going to be our operating assets, and as we go through the projection, we'll again identify those, or excuse me, not the projection, the valuation will identify those, just like we did when we went through the projection in an earlier class. The second kind of assets are non-operating assets. These are assets not used in day-to-day operations of the firm. For this set of assets, these are things we don't need to run the firm. Primarily, these are generally marketable securities or short-term investments, which is the excess liquidity that firms often have. And there are also sometimes intangibles, accounting assets, things like that, things that we don't need for the day-to-day value operations of the firm, so we don't include that in the value of operations for the firm. Another area you need to know about are spontaneously generated liabilities. These are typically accounts payable and accrued expenses. And just as the name implies, they are generated spontaneously whenever the company makes sales, whenever they increase their revenues. We expect them to have more employees working to generate those sales and those revenues. And those employees will have accrued wages and accrued payroll taxes and things like that. Accounts payable will increase with sales if we're buying things on credit from our suppliers. So as those sales increase or decrease, the accounts payable and accrued expenses will move with them. So we're going to identify these. Outside of spontaneously generated liabilities, all other liabilities I refer to as non-operating liabilities. They're not necessary for the day-to-day operations. These are going to be things like notes payable and long-term debt. Those are the result of a financing decision, so we're not going to include changes of those when we calculate the value of the firm's operations. Management can more directly affect the value of operating assets, so we tend to focus on those. And ultimately, because we're thinking of the firm as a going concern, in other words, we expect it to continue forever, at least in our valuations, and so we really focus on the operations of the firm, not the additional assets that they have that they don't need for operations. We'll add those back in after we determine the corporate value. The operating value. So the way we're going to estimate the value of operations, okay, that going concern part of the company, is using the free cash flow to the firm model. So this is referred to as the free cash flow And free cash flow to the firm model. And these are the cash flows that are available to all investors. Which includes equity holders and bondholders. There's a separate model which we're not going to use in here, but it's very, very similar, and you're going to see both of them if you advance in this area. And it's referred to as the free cash flow to equity holders model, or FCFE. And this actually just measures the cash flows available to equity holders. So we take out the cash flows that go to the bondholders or any other debt holders, and we determine the value today of the equity using the future expected cash flows available for equity holders. We're not going to use that model. It's not as popular as the FCFF model, but it is out there, and theoretically they should give you about the same value for a firm. To calculate the free cash flows to the firm, we take NOPAT, and NOPAT stands for net operating profit after tax, and this is equal to EBIT, which is earnings before interest and taxes, also known as operating profit, multiplied by 1 minus the tax rate. And then we subtract from that the change in total net operating capital. And net operating capital consists of net operating working capital, which are the current operating assets, or the short-term operating assets, less the spontaneously generated liabilities, and the long-term the fixed the fixed capital operating capital, or also referred to as fixed capital investment. And these are going to be your long-term fixed assets. And what we look for here is the change in the net assets, or net fixed assets, for this category. So from these we calculate. So what we do is we figure NOPAT for the year. We subtract out the change in the net operating capital. So what we're saying is that we've got our operating profit after tax. Note that it's earnings before interest. So this is free cash flows to all investors, including bondholders. So interest would be a cash flow available to a bondholder, but so we don't take it out because we want to leave that in there. So we have earnings before interest and taxes, and we subtract out the effective tax from that. So 1 minus the tax rate. So we're taking out tax, so what we're left with is earnings before interest. Okay, so these are the operating earnings available to all the investors, and then from that we're going to subtract out the investment we need to make in our capital, our assets, short-term assets and long-term assets. We're going to take out that amount to give us what we have left over that we could theoretically send out to all of our investors after that. Oftentimes what happens is that the firm will pay out what they're required to the bondholders, and maybe pay out a portion of what's left to the stockholders, but then retain a portion for reinvestment. So what we find to get the value of operations is the present value of the expected future values discounted back at the weighted average cost of capital. To do that, we calculate the free cash flows for the future periods, and then after a non-constant growth area, and you can also have a constant growth model for this, but we're going to work it using a non-constant growth model. So we're going to have a forecasted period of 3 years, and then we're going to say at the end of that time we're going to have constant growth in our free cash flows, and so we can discount all of our future free cash flows back to today and find the terminal value or the horizon value, or also known as the continuing value. To estimate the price per share, we're going to calculate value as the value of operations plus the value of non-operating assets. We add those back in. We're going to subtract out our interest-bearing debt and any preferred stock. In the examples we're going to work, we're not going to have any preferred stock, and your assignment won't either. And then we divide by the number of shares outstanding. We've actually done something similar to this in class before. If you look back in your notes to stock valuation, we did do a free cash flow model. However, we didn't calculate the free cash flows. So the major thing you're going to hopefully learn from this is how to calculate free cash flows for the firm. So once we do that, and that's going to be the example I work here in a few minutes, you'll be able to determine the value of per share for stock based on this method. There's a few other things I want to go over with you on valuation and really what drives valuation. So these are referred to as the 4 fundamental wealth drivers. The first one is growth in sales, and what I want you to know is how do these affect the value of the firm? And the answer for growth in sales, a lot of people think sales are growing, your firm's becoming more valuable, and that's not necessarily true. Whether or not growth in sales increases the value of the firm is dependent upon operating profitability and capital requirements. So we don't know. So I'm just going to put some question marks here. So let me give you an example of this. You can increase your sales, but at the same time sell your items at a loss. So let's say I sell items for $10 a piece, but they cost me $11 to build. So for every item I'm selling, it's actually costing me more that I'm getting from it, and I'm decreasing the value of the company. That's kind of a simplistic approach, but that actually happened to me at one of the jobs I was at. A guy I worked with did exactly that. He would price things out, units of production out, and charge people less than it actually cost us to build them. He got transferred to a different area pretty quickly after we figured that out. But in those ways, we were actually losing money on every sale he made. Okay. So that one, we don't know the effect. If sales go up, it could decrease value or increase value. If sales go down, it could decrease value or increase value. It just depends on our next two factors. The next factor is operating profitability. This is the number one probably thing that people miss on this assignment. I ask for operating profitability and they give me operating profit, which is just EBIT. That's not what I want to know. How we measure operating profitability is net operating profit after tax, and that's that first section of the free cash flows, divided by sales. Okay, so it should be a percentage or a decimal that gives you the ratio of net operating profit to sales. And as you could probably expect, an increase in OP, operating profitability, results in an increase in the value of the firm. Okay. And now this is all kind of messed up. I'm going to put this off to the side for now. We'll go over that in a minute. The next item that we have is capital requirements. And that's operating capital divided by sales. And I'll show you how to calculate operating capital. We'll also call it net operating capital divided by sales. This is the second portion, or the second argument that I talked about in the free cash flow calculation. So first we had net operating profit, and then we subtracted out the investment in net operating capital. So if capital requirements are high in order to generate new sales, in other words, in order to add, let's say, $1 of sales, I have to invest 80 cents in new fixed assets to generate those. Well, that would be kind of high, and it may not add value to the firm to actually generate those sales. So that's something we need to think about. If I have to build more and invest more to generate additional sales, then those sales may not add value to the company. So In this case, what we would say is that an increase in CR results in a decrease in firm value. Okay. So the more we have to invest to generate sales and to generate profit, the less valuable the firm is. Finally, the weighted average cost of capital. This is the discount rate for the firm's cash flows. Okay. So this is the discount rate for the free cash flows to the firm. An increase in weighted average cost of capital decreases the value of the firm. All right. So those are the 4 wealth drivers. And what we can see here, and I'm going to go over here actually. Go back to this slide. We'll just pull this information. We'll try to pull this information into the next slide here. There we go. So the first equation that I have on here should look familiar. It's the constant growth model for the free cash flow valuation model. So in this case, if I can get it to look right, which I'm not being very successful at. There we go. That looks a little better. All right. So we have the free cash flows at time n multiplied by 1 plus the growth rate divided by the weighted average cost of capital minus the growth rate. So hopefully that looks a little familiar to you. So this would be the value of operations at time n. So we'd find the next free cash flow, and then we divide that by the weighted average cost of capital minus the growth rate. Just as a reminder, this is for constant growth only. Okay, so if we're at that point where we believe that the free cash flows are going to grow at a constant rate over time, then we would use this model. Otherwise, we're going to use the non-constant growth model, and we use this to determine the terminal value. The next item is not something you need to really memorize or know about that much, but it is essentially what it is a breakdown of the first equation into the different wealth drivers. So this is our operating capital. So the value of the operations of the firm at any time are equal to the total amount of operating capital that the firm has, net operating capital, plus the sales of the firm for the next period, divided by the weighted average cost of capital minus the growth rate. So you can see here, if sales increase in this case, then the value of the firm would increase. But if weighted average cost of capital increases, then the value of the firm is going to decrease. The next argument here is operating profitability minus the weighted average cost of capital multiplied by the capital requirements, which, remember, this is a ratio, it's not a number, divided by 1 plus the growth rate. So if the weighted average, the cost of capital multiplied by the capital requirements discounted back at the growth rate is greater than the operating profitability, okay, so that's our cost of capital minus the capital requirements. If that's greater, the dollar amount, or the percentage, sorry, is greater than the operating profitability, then an increase in sales decreases the value of the firm. Right? Maybe a lot to take in, but you can actually look at this equation and kind of see how all of these different categories, capital requirements, weighted average cost of capital, operations, and growth in sales, okay, affect the value of the firm. And I'll ask you to evaluate that as you do your assignment. Finally, some key points about value-based management. An increase in sales increases the value of the firm only if the return on sales is greater than the cost of capital used to generate those sales. So the higher the capital requirements for new sales, so the more we have to invest, the less value those sales will generate. As weighted average cost of capital increases, value decreases because we have a higher discount rate. Finally, a higher operating profitability, or let me say an increasing operating profitability, increases the value of the firm. Then finally, the last measure I want you to know is the expected return on invested capital. So for sales to add value to the firm, the expected return on invested capital, that's what EROIC is. Let me just write that out. EROIC is equal to the net operating profit after tax at the next year divided by the invested capital, the dollar amount of invested capital. So that's our expected return on capital. And by the way, invested capital is at time t. At the end of time t, how much capital we have invested. And so that's how we would calculate whether or not it makes sense to grow sales for the firm, if that's a good strategy. All right. That's the lecture part of this. I'm going to take a little break now, and I'll be back in just a second. All right, well, I'm back. I just needed to get a drink real quick. What I'm going to do here is give you an example of calculating free cash flows and ultimately calculating the value of the firm. What I have here is actually the forecast lecture that the spreadsheet from the forecast lecture I made for earlier in the course. So you hopefully maybe remember this a little bit. What we have, I'll just go through the tabs with you. We have the balance sheet at the bottom, an income statement. And as you can see, we have the existing years of 2010, 2011, 2012, and then our forecasted years of 2013, 2014, and 2015. And if you want to go back and watch the other video, you can see how we came up with these numbers. So at the balance sheet, the income statement, then I calculated ratios, and I explained that a little bit in that video, the earlier video, on just looking at the ratios, seeing what's happening with the firm, does it make sense or not. And then finally, I've added another tab down here, and this is what I'm going to make available for you online. This is a free cash flow valuation tab, and what I'm going to do on here is determine the free cash flows for each of the years, including the past years, so we can get an idea of what they've been in the past. And then also for the next 3 years, and then we're going to assume a growth rate and determine the value of the firm from that. So I'm going to make this a little bit bigger. Yeah, that'll work. So I want to calculate the free cash flows for the firm and then the valuation. We'll need some information about the firm in order to do this. We need to know the tax rate. And if I look back on my ratios, looking at the wrong thing here. I'm going to look at my assumptions. See if I have anything here. My effective income tax rate for the firm is 26%, so we'll use that going forward. So my tax rate is 26%. My long-term constant growth rate, we're going to start with a long-term constant growth rate of 4%. And we'll mess around with this later on. A weighted average cost of capital, we're going to start off at 9.5%. And again, we're going to adjust that later on, so you can see a method of adjusting for it that we can use to reevaluate and revalue our firm. And then the number of shares outstanding, we're going to say that there are 1,500 shares outstanding, or if we're doing everything in thousands, that'd be 1.5 million. Okay. And then what we're going to start off with is just, if you take a look at those slides, we're going to start off by calculating net operating profit after tax. So that consists of, I'm going to go down one more line here, EBIT, taxes, using a tax rate of 26%, and then our net operating profit after tax from those two items. And we'll start with the year 2011, and then we'll calculate it for 2010, our historical years, and then our forecasted period, 2013, 2014, then 2015. So our EBIT, I'm just going to press equal. I'm going to go back to the income statement. And our EBIT is going to be equal to earnings before interest and taxes, and that's going to be right here. Okay. I don't count either interest income because that's not an operating income, or interest expense. So I'm just going to use operating income. And I can drag this over for each of the years. Resize my cells here. My tax rate is going to be equal to 26%. Here's a little trick. I think I probably showed you it before, but I'm just going to name this tax rate. Oops. Oh, well, I've already done that. All right. So I've already named a tax rate. I'm going to go back here now, and I'm going to just put in equals times our EBIT multiplied by the tax rate. So we're going to pay $17.31 in taxes, so our notepad is going to be equal to our EBIT minus the amount we're going to pay in taxes, or $49.28.40 for the first year. Now I'm just going to drag that over. Okay. So the next item, and I'm just going to go back to my slides here just to show you this again. To calculate the free cash flows to the firm, I'm going to take notepad minus the change in total net operating capital. So my next step is to determine what the total net operating capital is at the end of that year, and then calculate the change from one year to the next. Okay. So I'm going to put in net operating working capital. My net operating working capital, again, is my current operating assets less my spontaneously generated liabilities. And in this case, my net operating working capital is going to consist of cash, accounts receivable, inventory, and then I'm going to subtract out accounts payable and accrued expenses. So that's going to give me total net operating working capital. And then I'm going to add in net fixed assets. The reason why we don't use gross fixed assets is because depreciation is already taken out up here where we calculate EBIT. Depreciation expense comes out prior to EBIT. So we don't want to also include, taking that out up here makes it so we don't need to adjust or use gross fixed assets down here. And when we get into the next area in this course where we look at projects, we're going to handle depreciation a little bit differently. We'll actually use the gross fixed asset and then adjust the depreciation and add that back in. So for 2010, just going to go over here to the balance sheet, select cash amount for 2010, do the same thing for accounts receivable, do the same thing for inventory. Now mind you, in our projection lecture, what we did was already determine which ones were operating assets and which ones were not. Again, the operating assets were cash, accounts receivable, inventory, and net fixed assets. We don't include gross fixed assets or accumulated depreciation because the net fixed assets is just the net of those. Also in that lecture, I said that short-term investments and intangible assets were non-operating assets. Sometimes, depending on the strategy of a firm, an intangible asset may actually be an operating asset or a goodwill. For example, one firm that some students and I visited a few years ago, Regal Beloit. This was really their strategy of growing sales, is they went out and they bought other firms. So goodwill in that case, since it was part of their growth strategy, we would probably consider that an operating assets, because that's how they grew the sales of their firm. It's just going out and buying other companies. But in this case, we're not going to use those as an operating asset. It's not necessary for the day-to-day operations of the firm. Certainly, it's not changing with the firm, so these might be things like old trademarks that the firm has. And if they sold the firm, they'd certainly have value, but they're not necessary. They don't grow with sales, and they aren't a drain on cash if they increase, or a source of cash as they decrease for the firm. So we want to include those as a non-operating asset because they do have value, and we could get value from them if we sold the firm. But if we included them in our as a operating asset, they wouldn't reflect any value to the firm at all because they're not changing over time. So we want to include, sorry about that, we want to include inventory. And then we're going to find the accounts payable and the accrued expenses. And I'm just going to drag that down because the next one below were accrued expenses. So our total net operating working capital is going to be equal to the sum of the cash, accounts receivable, and inventory minus the sum of accounts payable and accrued expenses. I'll just pull that across. Then our net fixed assets for 2010 were equal to $40,100. We'll just pull those across. Make that a little bit larger. So our next step is to determine the total net operating capital. So our total net operating capital is equal to the sum of our net operating working capital. So notice the term working, we leave that out down here. Working refers to the fact that they're current assets and current liabilities. Okay. Plus our net fixed assets. And then what we're interested in is the change in net operating capital. So remember, that's what we subtracted out. And that change represents an investment. And in fact, in some cases, and maybe in your textbook, it's actually referred to as the investment in net operating capital. It's the amount in cash that we had to pay out during the year to increase or maintain our operating capital. So this reflects an actual cash flow. The change from one year to the next represents an actual cash flow for the firm. So what I'm going to do here is take 2011's, subtract out the amount for 2010. Now remember that a balance sheet represents a point in time, so we're looking at the total net operating capital at the end of 2010 and the total net operating capital at the end of 2011. So this represents the investment, the dollar investment in operating capital that we made during 2011. That matches up then with our net operating profit after tax in 2011. So we have our income, our cash flows from our operations, okay, less taxes there, and then we subtract out our dollar investment to generate those profits, and that gives us our free cash flows to the firm. So I'm going to take net operating profit after tax. I'm going to subtract out my change in total net operating capital, and that gives me a free cash flow to the firm of negative $1,775.76 for the year. You can't maintain negative free cash flows. If you do, your firm's not going to be worth anything. However, negative free cash flows for a year or two, especially if the firm's growing, isn't that uncommon. It's pretty common. We're investing in additional capital for the future. What you tend to find, and if you take the equity valuation class, you'll see this a lot. once a firm goes from being a high growth firm to a more sustainable long-term growth firm, they usually have a fairly large influx of cash. And if we look at companies out there, certainly 10 years ago, Microsoft, in the last couple of years, Apple, you'll start to see companies that go from high growth to maybe a more moderated growth generate a ton of cash very quickly, because now they don't have to make those large investments in capital that they were before. And that's what we see here. Our free cash flows become positive in 2012. Okay. And then we have our forecasted years. And what I'm going to do here, just so I don't get confused, is I'm going to highlight these. I'll find a nice mild color there. I'm going to highlight these so I don't get confused as I go through the rest of this. So when we value the firm, we don't include any of the past free cash flows. We've already received those, or those have already been dealt with. They're not available anymore for the investors for the firm. We're only concerned with the future free cash flows. So for our firm, the next step is to determine the value of operations. And in order to do that, we need to determine first the terminal value in 2015, because that's where we're saying that our growth is going to become constant. So we're going to use that constant growth model. What the constant growth model says is that the value of operations is equal to the free cash flows for the next year. So the free cash flows for this year multiplied by 1 plus the growth rate divided by the weighted average cost of capital minus the growth rate. So that's what I'm going to put in here. I'm going to first start off with the numerator, which would be the free cash flows for next year. Okay. So that's going to be the free cash flows for 2015 multiplied by 1 plus our long-term constant growth rate, because that's what we say is going to start after 2015. So 2016's free cash flows will be 2015's multiplied by 1 plus the growth rate. We're going to divide that by the weighted average cost of capital minus the growth rate. And we get a terminal value then, or value we could sell the operations of the firm for in 2015 of $58,443. So our total cash flows, if we held onto the firm until 2015, so we could sell the firm for the $58,443, and we'd receive the following free cash flows in the meantime. Okay, the $27.75, the $29,1579, and then for the final year, we'd receive the free cash flows for the firm and add in the terminal value to get $61,533.82. Okay, so those are the free cash flows that are available to all the investors. The next step is to find the value of operations. And that's going to be, for that we're going to take net present value, and you can do this in your calculator using the free cash flow worksheet. The rate is going to be the weighted average cost of capital. And then our free cash flows will be the cash flows for the calculation. And we get a value of operations today of $51,811.37. If you look back in the notes then, the next step, so this is, let me stop here. This is the value of operations today, or at the end of 2012, for the firm, if we just sold the operations of the firm off. And from that, we'd have to pay out any liabilities that the firm owed, and we'd have kind of an equity value, but we also want to add in our non-operating assets. So in order to determine the total value of the firm, we want to first add in the value of non-operating assets. And we had two that we specified in the balance sheet earlier on, and these were the short-term investments and the intangible assets. Okay. So our short-term investments, I'm going to go back to the balance sheet. And these are going to be in 2012, because remember, that's when we're valuing the company at the end of 2012. So our short-term investments are $905, and our intangible assets were equal to, in 2012, $23,000. So we're going to take the value of the firm, or the value of operations, and add in the value of non-operating assets to get our total value of the firm, which will be equal to 51,811.37 plus 905 plus 23,000, giving us a total value of the firm of 75,716.37. Now we're going to subtract out our non-operating or non-spontaneously generated, we'll say, our non-spontaneously generated liabilities. I pointed out two of them on the balance sheet. Those would be the notes payable and the long-term debt. The reason why we include any liability that isn't part of the spontaneously generated ones, the accounts payable and the accrued expenses, is because these are claims against the value of the company, and those claims have to be paid before the equity holders can get any money from the firm. So if we had other debts out there, such as capital leases, such as long-term, taxes payable or anything like that, those have to be paid off first before the equity holders get anything. So we would include those in here. So our notes payable for 2012 was $1187.75, and our long-term debt is equal to $23,474.57. Okay. So our value of equity will be equal to the total value of the firm minus notes payable minus long-term debt. So this is the equity value of the firm, and if we wanted to see how close we are to the market value, or if the market's correctly priced, or if our valuation is done correctly, we would actually compare this to the market capitalization, the number of shares outstanding multiplied by the price per share, to determine if it's a close match there. And we can also calculate the price per share, which I'm going to do now, and compare that to the value per share. The price per share is pretty simple to calculate. We just take the equity value and divide it by the number of shares outstanding. So our shares outstanding were 1,500. So we get a price per share of $34.04. I hope that makes sense for you. I'm going to save that now, and then I'm going to do a few adjustments. So one adjustment I'm going to make is weighted average cost of capital. So let's see what happens to the value of the firm. Right now it's 3404. If I adjust the weighted average cost of capital. In order to effectively do this, I had to point back to this cell. So if you look here, when I calculated the terminal value, I pointed back to the weighted average cost of capital cell. If you put 0.095 in here, what I'm going to do doesn't work. You need to point back to the weighted average cost of capital here. When I calculated the value of operations, again I pointed back, my formula pointed back to this cell. So if I just change the cell value, let's say I change it to, well, we don't want that, I change it to 12%. So my value goes from 3404 to 2322. So that's a significant decrease in the value of the firm, with a not extremely large increase in the weighted average cost of capital. So I'll put that back at 9.5%. Our long-term constant growth rate, I mentioned before that in some cases the value of the firm will decrease if we increase the sales growth, or it can decrease if we decrease it. So what I'm going to look for here is, does an increase in the constant long-term growth rate of the firm increase the value of the company? So if I increase that to 6%, We see that it does. It goes up quite a bit to $51.89. So the next thing I want to show you is something I use quite a bit for sensitivity analysis, and that's just to see what happens to the value of the firm for different weighted average cost of capital, and then we'll also do it for different growth rates. Okay. So in order to do this, we use a data table, and here I'm going to put equals, an equal sign, and then go and put in the price per share. Okay. It's important that you don't put numbers into your equations, that they point to the assumptions, because if you do, this won't work. Okay, now I'm going to put in this column, I'm going to put in the different sales growth amounts. I'm going to start with negative 0.05, negative 0.04. In other words, what we're saying is actually sales growth is going to fall in the long term, which can happen in a dying industry. And then I'm going to just go and increase it to 15% so we can see what happens. So I highlight that and I go to Data, What If Analysis, Data Table, and I'm going to use the column input cell. You can have a one-way data table, and that's what we have here. We just have a single column and a single variable that we're changing. In that case, we're looking at the column, so we're going to use the column input cell. And the column input cell is actually going to be the number over here that we want to change. So I want to change the long-term growth rate. So what this does is that what Excel does here is that it puts negative 5% in for this number and recalculates the share price down here, and then it's going to put the new share price up there. So this is what we end up with. If we have oh, I didn't want that. Actually, we end up with something really interesting here. So what we end up with is, as we grow our sales up to a point, the sales increase the value of the company. So what happens after 9% growth rate? Well, after 9%, so remember our weighted average cost of capital is 9.5%. So if our growth rate is actually higher than 9.5%, our denominator in the constant growth model, the weighted average cost of capital minus the growth rate, becomes negative. And so that's why we get a negative number down here. So we know this can't actually happen. We can't have a growth rate, a long-term growth rate, that's higher than the weighted average cost of capital. And if you want a nice little graph, you get something really weird looking like this, where the value increases and increases and increases up to that 9.5%, and then it drops. Okay, and that's just because of how we calculate it. We can't have this down here. Okay, we can never have a negative stock price. So what we see is that the stock price increases with the growth rate up to the weighted average cost of capital. The last one I'll do is a weighted average cost of capital, just so you can see again an example of how this works, and also the effect of the weighted average cost of capital on the value of the company. Again, I'm going to put in the stock price. I'll start the weighted average cost of capital at, let's say, we know it can't be below the long-term debt rate, so I'm going to start it at we'll say 7%. Okay. So I'll start at 0.07, and we'll go up by half percentages. So I go again to data table. My column input cell is the weighted average cost of capital. And we see here what we predicted based on what I lectured over is that we increase the weighted average cost of capital, we increase that discount rate, the value of our company falls, the value of our stock falls. So we start at 7%, we have a price of $62.90, 7.5% increase decreases the value to $53.83, and so on. For a manager, this is important because if we can decrease the weighted average cost of capital and not affect anything else in the firm, we actually increase the value of the firm. And a lot of people don't think about that. They think an increase in sales may increase the value of the firm, an increase in profitability, but actually just a decrease in the weighted average cost of capital. If we can make the company safer, the projects less risky, while maintaining their cash flows, while maintaining their profitability, not increasing those, we actually increase the stock price. People become more comfortable with it, feel the company is a safer company. They're willing to pay a little bit more for those same cash flows. So I'm just going to insert a table here so you can see visually what's going on. So as we increase, again, we increase the weighted average cost of capital. So this is the weighted average cost of capital on the x-axis. The value of the firm falls. You see that's pretty dramatic, that it falls pretty dramatically as we increase the weighted average cost of capital. I hope this was helpful for you. I'll put an assignment out where it's going to be very similar to this lecture, where you're going to calculate the free cash flows for the firm, you're going to calculate the value of the firm, and you're going to calculate the I'm going to have you work some problems like this, not exactly these problems, where you're going to change a few variables to see what happens to the value of the firm and report those back. All right. Please let me know if you have any questions about the lecture or the assignment. I look forward to seeing you on Monday.